John, I'm gonna put the spotlight on you for a little bit. As we look at kind of
Okay.
the broader landscape of professional services
Professional
firms
services firms.
who have been down this road before, as you, what are some of the kind of key lessons learned or key takeaways that you might give some insight on for us?
I think the key is that think of this, it's not really a transaction. It's really a transformation. Firms that succeed recognize early that this is not just a liquidity event. It requires a real shift to operating like a real business, building a scalable infrastructure, um, committing to long-term value creation. And it's not just taking chips off the table or de-risking your investment. It's really, how do we grow our firm post transaction? I think one of the things that has to evolve quickly is governance, right? Traditional partnerships probably have been too slow and too consensus driven in order to move. I think you need to move faster in this environment. You have to empower professional management. You have to separate the ownership from just the operational leadership and creating clear decision rights. Without that shift, the execution will become inconsistent and the value creation stalls, I think. I think, cultural alignment, is key, right? Firms that are culturally aligned are the ones that are going to be successful. And, introducing the PE brings that increased transparency, brings that financial clarity, performance accountability. But those lessons will not be successful unless the culture is there and the partners buy in to this new way of working. And people have to realize that that structure is going to be really important in order to grow. Incentives drive behavior, right? So the firms that perform the best get alignment from their partners, their investors, their management team. Where there's misalignment, especially around equity or compensation, I think you tend to see more friction and more key of certain loss of key partners. So I think that behavior and that culture it cannot be understated. And I think, just closing the deal is a starting point. Closing a deal, as many lawyers know, is difficult, but that's just the real starting point in this. And then like, the real upside becomes from embracing margin improvement, embracing the cross selling, as you have the ability to use some of that capital that you have now to deploy it for real strategic partnerships with other firms or other providers that can help fuel your growth.
Mhm.
That's a perfect opportunity to increase your margins and really looking at operational efficiencies. So, I think those are the key things. And I still feel like, to Larry's point, talent risk doesn't go away. Retention isn't an automatic, but I think, you know, key rainmakers will continue to leave if expectations aren't met. But I think if we do this the right way, to Larry's point earlier, to his friend that's been trying to retire, there will be more retention at those levels. And then you get into like scale and technology become the differentiators, right? How do we scale our firm? How do we utilize technology? And PE-backed firms that win tend to have a big investment in technology, a big platform that's standardized and scalable, and they're not afraid to invest in it. Where traditionally law firms have always been a little nervous about investing in technology. It's more of a dip the toe in the water. Going forward, there's going to be more of a dive in. We are going to use technology in order to grow. And I think really the quality of their revenue matters, right? Really looking for recurring, predictable work, institutional client relationships, and not only not having that over reliance on a few individuals who are the key to a firm, really building out a firm that mitigates that risk and can have an impact on value going forward.
Yeah,
Thank
just
you.
to jump in, I mean, it depends on perspectives, but when there's an unknown or a novel structure, it can cause some unease for some. But I've heard others, expressing that a smart institutional capital provider wants to back that business, I'd prefer to be alongside that than perhaps not. And so, if it's an opportunity to turbocharge that business to accelerate what people are already looking to achieve, if done correctly, then it should even strengthen that alignment between everyone.
Strongly agree with all of that. And I think John's point on technology needs to be underlined. Historically, it's been difficult to get law firms to make long-term investments because, at least in the recent past, some of the partners whose buy-in would be needed weren't 100% sure that they would be still around and, able to realize the benefits of the investment. So to take a dollar out of their pockets now in exchange for the potential return 5 years later, that's tricky to do in a cash economy. Much easier to do in a world of real equity, which is what the MSO structure will hopefully lead us to. But it is increasingly important. Again, I don't think it's an accident that we're seeing substantial investments in technology starting to at least be talked about by law firms. Number one, you're going to need it because clients will insist on it. But number two, you're going to need it as a differentiator. You're going to need it to create a moat, particularly in a world where cash compensation needs to come down a little bit. You're going to need to get away from the star system, to get away from a world in which partners can fly out the door with your key clients. You need to create firm-wide value for those clients to make them stickier clients. And I think that's one of the things that a substantial technology program carefully designed could do. That certainly worked in investment banking and solved exactly the same problem there.